Hello, this is Tom Siomades, Chief Market Economist at AE Wealth Management. I hope you had a great holiday season and everyone's well. 2025 is in the books and the final quarter of the year was just as frantic as the first three quarters. Right out of the chute, the quarter started in turmoil with the government shutdown, supposedly over Obamacare subsidies. That lasted a record 43 days. With the government closed, vital economic data that the markets need to make daily decisions stopped flowing, and we were virtually flying blind. Aside from an emergency calculation of inflation to determine the 2026 Social Security cost of living adjustments, no data was being calculated or reported. No employment numbers, no CPI, etc. It's never a good thing for the markets not to have validation and guidance on how things are going. Markets aren't complacent and will create their own narrative, which is usually beneficial to traders, but not long-term investors. Then, to make things a bit more challenging, 2/3 into the shutdown, the Fed lowered rates for the second time in 2025. That may have seemed like a good thing, and it was, until Fed Chair Powell stepped up to the microphone and said that due to the lack of data, the Fed may be forced to pause its rate cuts in December. Up to that point, markets were hitting record highs, based on the assumptions that A, we would get another 25 basis point cut in December, and B, that the shutdown would not have a significant impact on the economy, and the data would validate that when it was finally released. With a December rate cut in jeopardy and the shutdown dragging on, the markets decided to take matters into their own hands. Volatility spiked, and we had a vicious little sell-off that finally ended just before Thanksgiving. This was the first major downdraft since April, when the first tariffs were announced. The good news is we recovered and advanced after Thanksgiving, and we did get our third rate cut. But the experience sent the jolt through investors just the same. A couple of factors played into this. First, AI and big tech stocks have been investor darlings for some time now, despite lofty valuations. With no data and fears that the Fed wouldn't cut rates, those same stocks became overvalued. And the sentiment became that we were going to see shades of 2018. For those that remember, that year, the S&P 500 had a good first three quarters, but basically blew up in the last quarter, led by a narrow group of large cap stocks. It was the first time the S&P 500 had ended negative since 2008. Second was Powell and his comments. His excuse that the lack of data would make formulating policy difficult caused all sorts of turmoil. Quote, "What do you do if you're driving in the fog? You slow down." End quote, was how Powell put it. That's just not so. The Fed has a huge staff of economists and analysts, and if any organization can continue without government data, it's the Fed. Then there are other sources of data outside the government, like the ADP employment report or the University of Michigan consumer sentiment, which could also inform the Fed, not to mention all the prior data that was released showing stagnant inflation and a weakening jobs market prior to the shutdown. And hasn't Powell ever heard of fog lights? In my opinion, this was yet another in a long line of missteps by Powell, at a time when the country was off balance. It's much like his, quote, "inflation is transitory" stance, or the jumbo 50 basis point cut the Fed made just before last year's election, when the economy was in far more robust shape than it is now. It's hard to reconcile Powell's claims of the Fed's political independence with his actions. It's well documented that Trump doesn't want Powell around and that Trump will replace Powell as Fed chair in May. Trump even announced that he has someone in mind to replace Powell in December. Despite fears and dire warnings, optimism won last quarter. Several major Fed officials stepped up and said they supported another cut in December, which we got on December 10th. The markets, which began its comeback on Thanksgiving week, accelerated to close out a strong, albeit turbulent year. Second quarter GDP was revised to 3.8%. A not so surprising first quarter GDP came in at a negative 0.6%. That number was a bit fluky for the first quarter because imports were running much higher in advance of the tariff announcements. The first reading of third quarter GDP was delayed by the shutdown and was not released until late December, but we grew again in Q3, and I expect Q4 to follow suit. The fourth quarter was a fitting end to a bizarre year. Large swings and record highs were plentiful and eventful. There was plenty to get panicky about, but the market rewarded patience and discipline. I don't expect 2026 to be milder. In fact, it might even get spicier, if you can believe that, given it's a midterm election year and both the House and Senate are up for grabs. Plus, there's always something the 24-hour news cycle needs to be talking about. If there's nothing new, a crisis will be created to capture our attention. I'm sure we'll have more surprises that we did not anticipate. I said this during the third quarter market talk, and it bears repeating. Before you drop what you're doing and act, ask yourself if what you are hearing and seeing is something that would be considered a time when a difficult or important decision must be made. If it is, then you truly have a crisis. If it's just noise and doesn't impact you, your family, or your community, go back to what you were doing and live your life. You have done the hard work, you have saved and planned, and now it's time for your money and your plan to work for you. Enjoy the fruits of your labor and skip the stress. We'll be back together in a few months to recap the first quarter of 2026. Stay diligent, call your advisor, review your goals with them, and make sure you're heading in the right direction and are not exposed to any unintended risks. The beginning of the year is a great time to evaluate your situation and make adjustments to your plan. If your allocations have strayed from your targets, rebalance now. The new year is also a good time to think about taking some gains since you have the remainder of the year to tax loss harvest. Once you're done taking those gains, stay the course and be disciplined, since long-term investors are usually rewarded. It's hard to believe 2026 is already here, but it will go by just as quickly as 2025 did. Please reach out to your advisor if you have any questions and make sure your goals and objectives are aligned with your portfolio and strategy. Thank you and take care.